Hello, everyone, and welcome to another episode of DAO Today with Aleksa Mill. Today we have a special guest, Alireza. Hi, Ali. Welcome to today's episode. I'm super happy to have you here. And would you please introduce yourself and how did you get started in the industry?
Hi, Alexa. Thank you for having me today. I'm very looking forward to talk to you today about the MiCA topic. So just some insights where I'm coming from, what I'm doing. So I'm a German-based lawyer and partner of a law boutique firm called Annerton. We're focusing on regulation in the industry of banking, financial companies, but also fintechs. And I'm a partner dealing with regulatory for more than 10 years, and I'm dealing with blockchain and DLT already for some time, since 2014. And this is also one of my main topics I'm dealing with. So everything which is related to DLT and blockchain, so helping German banks, asset managers, but also the crypto native industry like crypto exchanges, startups which deal with NFTs, for example, companies which tokenize non-bankable assets. And besides being a lawyer in a law firm, I'm also quite active in associations. I was for a long time a board member of the European Commission's Blockchain Association in INATBA, where I was also helping drafting the first draft of the MiCA text. I was for a long time helping the German government as an expert implementing the EU regulations such as the fifth anti-money laundering directive into German law, helping understanding of crypto assets and the regulated services we have in Germany, like the crypto asset service provider. And now also I'm continuing that with helping the industry, and I'm also quite active in publishing. So I'm publishing a lot on crypto assets such as the MiCA, but also the new German law on the electronic securities which we have. And I think that gives a good insight of what I'm doing and what I'm going to do. And as I said, I'm very happy today to talk to you about MiCA, and so let's go into it.
Amazing. And thank you for taking the time to come on and discuss this very important topic that will not only affect EU, but businesses globally. Would you please break down to us what MiCA actually is and why does it matter?
Yeah, so MiCA stands for the Markets in Crypto Assets Regulation. And for those who are familiar with regulation, they see that it looks similar to MiFID, the Markets in Financial Assets Directive. So, and this is the first thing which we need to understand. We have the MiCA, which is the regulation of crypto assets, and we have the MiFID, which is the regulation of financial instruments. So this is the first, I think, nutshell we should take away. But for those who are interested in how the MiCA was created, we have to look back a little bit just. We have to look back at 2019 because we had the EBA, the European Banking Authority, and ESMA, the European Securities Markets Authority, who published two very interesting papers at the same day. They are both called Advice on Crypto Assets. The ESMA, they highlighted in their paper at that time that within the European Economic Area, we do not have a harmonized understanding about crypto assets. So, for example, Germany is regulating cryptocurrencies and many utility tokens already since 2014, because Germany was the first jurisdiction, and the German regulator, the BaFin, was the first regulator globally which issued its understanding or published its understanding on crypto assets. At that time, it was only Bitcoin, so it's cryptocurrency, and why Bitcoin is regulated and how investors should watch out about the risks of such instruments. But other jurisdictions, like the majority of those jurisdictions within the European Economic Area, they do not regulate at all cryptocurrencies. So, and this is something where we in the European Union, which is not working, because in the European Union, we say we have a single market, we have a level playing field where we should regulate the instruments, no matter if it's crypto assets or financial instruments, in the same manner. So we should not have what is called also regulatory arbitrage. So companies going, let's say, to East Europe like Iceland or Lithuania and thinking of that they can make use of those legal framework to then act within the European Union, because we should have a harmonized approach. So ESMA brought that up in its paper at that time, and EBA also brought up something similar, but more in direction of having the same rules when it comes to anti-money laundering. And all of that was applied in the 5th Anti-Money Laundering Directive, but it was highlighted that we need, not just for money laundering, but also for the regulation in general, a common understanding within the European Economic Area. And this is how the MiCA was produced. And the MiCA going forward is going to have a harmonized framework of crypto assets. So crypto assets are going to be regulated in the same way, in the same manner. And because the MiCA is a regulation, it is going to apply directly to the whole European Economic Area, unlike the MiFID, which is a directive which would need to be implemented into national law. But the regulation MiCA is applicable directly, so it does not need any implementation. And so we're going to have this MiCA being applicable for the whole European Economic Area directly, once it's effective and once it's fully applicable. And it's going to cover crypto assets. And this is the interesting part. What is crypto assets? And looking at crypto assets, we can say we have two kinds of crypto assets. We have the utility token and the currency token as one bucket. And then we have the stable coins on the other hand in the second bucket, which is the e-money token and asset reference token. So we have stable coins and all other crypto assets within the MiCA. And so we're going to have for the crypto asset service providers, so CASPs, regulation on how to deal with this crypto assets. So they would normally need a license to provide the services and activities within the European Economic Area. This is for the ongoing services. And we have also some regulation for those who want to issue a new token. So who want to issue a token within the European Economic Area, who want to generate like a token generating event or an ICO or an STO. And for those, we're going to have some mandatory documentation requirement, which is very similar to prospectus regime, which we already have in a MiFID, in a MiFID catalog. But here it's called white paper. So we're going to have a white paper requirement for any token issuance. So no matter if we are in the first bucket, so utility token and cryptocurrency, or we are in the second bucket, the stable coins, for any of those crypto assets going to be issued once we have the MiCA, there's going to be a very strict rule on the white paper.
Okay, yeah, that's going to be interesting. But hopefully, if it also filter out some scam projects and not so honest initiatives. Thank you for explaining that in more depth and what MiCA is and what it applies to. Since the stable coins have become quite the topic since the crash earlier this year with Terra, and from what I read, actually that part of MiCA came as a result from the crash and how it affected. From somewhere I read that it actually destroyed around 40 billion in assets of people globally. So it did leave a really big impact on the industry and on the investors. Could you please tell us, how does MiCA regulate stablecoins?
Yeah, so the stablecoin regulation is one of the core goals of the MiCA. And going back to, again, some history lesson. So going back, those of you who remember, we had Facebook who planned to initiate the Libra or the Calibra wallet and the Libra coins within, at that time it was Switzerland, but the goal was to distribute it in Europe. And then that became Diem. So this was the goal of the Facebook, of the group of Facebook companies, and which was a very big group of companies and corporates participating on that project, which raised lots of concerns with the regulators, because the regulators were afraid that if we do not have any kind of regulation for this kind of stable coins, the market, the capital market, may be affected by this big project, because the companies which were involved there were like really major companies, and at that time we didn't see anything such major project coming. So this was for the regulators already some warning. So, and if you talk to some of the politicians active in the MiCA, if they're honest to you, they will tell you that MiCA was actually planned to being drafted and implemented to stop Facebook and similar players who want to issue a private stablecoin, which may have negative effect on the capital market. And in the end, they succeeded, we have to say, because Facebook has left Switzerland, and with that, the European market, and went back to the US market, and is now planning to issue something which is more in line with US interests. So looking at the stable coins, as I said in the beginning, we have two kinds of stablecoin regulations inside MiCA. We have the e-money token and we have the asset reference token. So, and very simply differentiating these two types of token, the e-money token is a token which is referencing to one underlying, which must be a fiat currency. So it could be an e-money token like on euro, or e-money token on the US dollar. However, once you have, besides just one fiat currency, a second asset within the bucket, so let's say you have the US dollar and you have some US bond, then you get to US tether. This is not an e-money token under MiCA. This would be an asset reference token. So anything with more than just one asset which is referenced to the token would be an asset reference token. And so the e-money token and the asset reference token, they are two different categories within the MiCA because different rules apply to it. So in a nutshell, you can say that the asset reference tokens, they are more heavily regulated compared to the e-money token. So it doesn't mean that the e-money token is not regulated at all. It is also strong regulated, but not as strong as the asset reference token. And the second nutshell, or the second takeaway, if you have an e-money token which is referencing to the euro currency, it is easier regulated than an e-money token which is referencing to a non-EU currency, for example, US dollar. So this is something for those who are planning to issue a stablecoin and to offer that to the European Economic Area. They should take these two nutshells with them and to think on how to structure the stablecoin.
That could pose quite a roadblock and an issue and a challenge when people are launching projects as such. And I had some talks with founders who are looking to initiate a stablecoin, and I was like, well, how about MiCA, right? Like take two steps back and make sure that, in a year or two, you're not going to encounter like a really big problem when it comes to having actually US-based investors. And of course, we know that US is not really crypto friendly, so that adds additional challenges and weights on the project. And would you share with us how, like, some of the existing projects that do have stable coins and that are backed either by US dollar or a different currency, so what measures they can take in order to be compliant and to be able to have EU-based investors? Do they have to open an additional entity, or do they need to go through additional checks? How they can save their projects and stay within EU?
So there are actually three ways on how to continue a stablecoin related business. First of all, the first thing which I'm saying is does not differentiate between if you are an issuer of a stablecoin or if you are a distributor or someone who is providing services in relation to stablecoins. So the first thing what I'm telling you is the so-called reverse solicitation. And reverse solicitation means that if your business is outside of the European Economic Area, however, you have users, you have investors, you have clients who are domiciled or located within the European Economic Area, you are allowed to provide your services to such users, clients/investors, if the request to provide the services is coming actively from the users. So it is not coming from the service provider, but it's coming from the users. So it must coming from the users, the request to get served. This is called reverse solicitation. On the other hand, reverse solicitation would not apply if a company is, let's say, located on the Bahamas or somewhere else, is having its web page or application and is directly targeting European investors, such as using a language which is only used in the European Union, such as German, let's say, using wording which may lead to the assumption that you're really targeting German users, such as having benefits for Austrians, Germans, Swiss people. It becomes tricky if you use like an international language such as English or let's say Spanish, because it's also spoken outside the European Economic Area. However, for example, if you use influencers or some others who have a big target group or a big follower group within the European Economic Area, and you use such influencers and tell them, oh, here's some influencer code, use it on your YouTube videos or somewhere else, and who's ever using this influencer code to register on our platform, you will get some, some kickbacks. This is also not allowed. I mean, the German regulator is checking out YouTube and is checking out social media, and if they see influencers who have a massive German follower group, and then they're using influencer codes from, let's say, an exchange or for some platform, then the German regulator would assume that you are actively targeting the German market by doing so. The same counts if you are promoting or sponsoring an event which is inside the European Economic Area. So all of that would not be considered as reverse solicitation, and then you would need to have a license or some regulation. So this brings us to the second part. So if you're really actively interested to provide your services inside the European Economic Area, we need to differentiate between issuing a token, like issuing a stablecoin, or providing services to an existing stablecoin. If you're issuing a stablecoin only, you do not need to have a presence inside the European Economic Area. You can do it outside. You only need a white paper. And you need to take that white paper and you need to give it to one of the regulators within the European Economic Area, and you need to notify the white paper and get some acceptance on your white paper. And then you're allowed to distribute your token within the European Economic Area. If you use an existing token, an existing stablecoin, you want to provide services to that stablecoin. Let's say you have an exchange token which gives you some possibility to use it on an exchange as a means of payment. Then you need to have at least a legal person. So you need to have a company inside of the European Economic Area. It does not have to be in Germany. It could be in Luxembourg or somewhere else, or wherever you think it's benefiting your business. And this company needs then to apply for a license. And then this is a license application procedure. It takes some time. Once you have the license, you're allowed to provide the services, not just in that jurisdiction where you applied, but you can provide your services to the entire European Economic Area by passporting your license to the whole European Economic Area. So I hope that this complex topic was put some way that it's digestible for the listeners.
Yeah, it's really great, and thank you for clarifying the relationship between like actually issuing a stablecoin and providing services. So I think that's a very important distinction for the investors, for projects looking to launch, and just about anyone in the space. And it's really interesting what you said about the influencers. So basically, if I understood well, if let's say I'm an influencer and I get paid and I have that promo code, right? So then the German government would have insights into that and would treat it differently. But what if I'm just like an influencer that ran a project, I really liked it, and then I decided to talk about it on my YouTube channel? Does the same rule apply there, or it's not considered as to fall under the stablecoin regulation?
Yeah, so the same would not apply in that situation. So there are lots of influencers who like to talk about some projects, some crypto projects. So if those influencers do not get any kickbacks, so they do not get any benefits from the company, such as promo code, referral code, or maybe some direct payment, then this is not related or connected to the company itself. So the company cannot do anything against it if some influencer starts talking about the company. So that's fine. But as soon as there's a link between the influencer and the company, such as a promo code, or someone knows exactly that the influencer is maybe getting some payments by that company, then any activity of those influencers would relate or would be seen as activities of that company.
Great, thank you for explaining that. And one of the most common questions when it comes to MiCA is whether MiCA regulates NFTs.
Yeah, that's a very interesting one, the NFT regulation under MiCA. So putting it really like the result already there is that MiCA is not going to cover really a real non-fungible token. And when I'm saying a real non-fungible token, I'm talking about the fungibility. So it has to be non-fungible. And non-fungible is not that easy to define. I mean, you can look at the technical aspect of the token. For example, is it an ERC20 or is it an ERC721 token if it's on Ethereum? So in ERC20, as a standard which provides that the tokens can be swapped or exchanged against another ERC20. However, an ERC721 is a standard which is used especially for NFTs because it is unique. So it's the 721 token cannot be replaced by another 721 token. So this is the idea from the technical background. But it's not sufficient just to look at the technical standard. You would also need to look at what is a token really covering. For example, you can have a token which is 1,000 times issued, so an NFT which is 1,000 times issued, and all 1,000 tokens are the same. They're exactly the same. So maybe they have the same image and they have the same rights covered with the token. However, they are all issued on an ERC721. So even though they are issued on an ERC721, which is a unique technical standard, the content or the rights covered by the token, they're all the same. And in that sense, you would say from a European regulator's perspective, they belong to a collection, and therefore they're again covered by the MiCA. So the MiCA should not cover non-fungible in means of technical being unique, in a technical sense be unique, but also from a right sense, so from the sense of what is covered with the token, it should be unique. So the other example would be the Bored Ape Yacht Club NFTs. These are on an ERC721, and each image which represented by the token is different. So you will not find the same image twice. It's always different. And therefore, I would say in that case, it is really non-fungible and would not be covered by the MiCA. And then you're not regulated by the MiCA.
That's interesting. So it's in small details how to mitigate some of the potential risks and take into consideration when launching a project, an NFT collection. And one of the very important elements of MiCA is also regulating market abuse. Can you tell us a bit more about that? How does MiCA address and regulate the market abuse issue?
Yes, so for those who are familiar with market abuse regulation and market abuse directive, they know that we have this already in place for MiFID financial instruments. And the reasoning behind having this regulation goes in two directions. One is to protect the investors, to have all the information which is available on the instrument being transparent for all the investors, so having equal information, so not putting any investor in the dark, let's say, and not putting any benefits for some specific people. So therefore we have some insider trading regulation, which means that people who are inside a group of some persons who have more knowledge should publish that knowledge immediately, so everyone has this understanding. This is so one side of the regulation when it comes to market abuse regulation. The other side of the regulation is what we see quite often in the crypto market, is this pump and dump activity. So you have, let's say, a Telegram channel or Telegram group where people are motivated to invest in a token, and they do so. And then you see that after some time, this token is dumped because it was all just pushed by some people who had the same interest in pushing the price up of the token, but selling it immediately once the price is up on a market. And such pump and dump activities should also be eliminated by the market abuse regulation. So the MiCA market abuse regulation is very similar to the market abuse regulations which we already have in MiFID. And if you can just take in a nutshell these two main ideas of having same equal rights and understanding for all the market participants, and also to limit any scams and pump and dump activities, you already know a lot about this market abuse.
Great, thank you. I read that all that insider trading, pump and dump and signaling would actually have to be transparent, and the information has to be available to the public that those activities are actually happening within the project. So there is no false pretending that, yes, like this project is so great and popular and everyone is so into it. But in fact, it's just a paid type of marketing and trading to scale the project and make people interested to invest in. And earlier this year, unfortunately, 2022 was experiencing a fair share of crashes. And one of the bigger ones that have really shook the whole industry, as you mentioned, was Terra, but also Celsius and the unfortunate event that followed, especially in terms of the investors' assets. How did MiCA respond to that? And how does it regulate the consumers and the protection of the consumers?
Yes, so MiCA is doing a lot in that direction. The consumer protection part was one of the main goals of MiCA, and so there are the different ways in how MiCA is trying or aiming to give more consumer protection. One is the transparency part. Transparency means that the documentation which is used, for example, a white paper, has to be true and not misleading, and also any liability language used inside the white paper, which says, for example, we do not warranty or guarantee any outcome, and this is just an experiment or whatever, is not allowed. You would be liable as a company for whatever you put in your white paper. So this is something which MiCA is giving in the first place. The second thing which MiCA is doing is looking at the companies, the service providers. It gives some obligations to the companies. For example, to the crypto custodians, there is going to be a rule of the segregation of funds. So we've seen that with Coinbase, where they made their report towards the US authorities that the funds of the Coinbase users, they may not be protected in case of insolvency, because there's a wallet where both assets, the asset of Coinbase and users, are getting mixed up. So we're going to have this segregation rule for the custodians coming. And this is a very strong segregation rule, not just in theory, but also throughout the whole operation of the custodian. So not just when having it in cold storage, but also in hot storage, and also when you trade, there must be always throughout a segregation of the assets. So this is one thing. The second thing which is coming for the operators, for the CASPs, is the obligation to keep reserves. And this keeping reserves, we've seen it with FTX recently, is very important, because there must be a balance between the assets you have under management, or the assets you have you're providing services to, and the assets of the company, which is the equity of the company, and also a reserve on top of the equity of the company, which may be used in case something is going wrong. We see, for example, Binance, which is using its own funds and putting some own reserves, which is outside of the MiCA, because the MiCA is not there, but they're already trying to do something which goes in that direction, what MiCA is going to put as a mandatory rule for all service providers, to have some funds available in a specific ratio to the assets under management. So if in case something is going wrong, we can use it. We have something like that already in place for banks. Banks, for example, they need to have some reserves depending on the type of business, but it's usually between 12 and 19%. on top of the money they would need to have as their own equity capital. And something like this we're also going to face for the CASPs within the MiCA. So there's much more when it comes to consumer protection, but I think these three examples, they give a good insight, especially when looking at the recent developments like with Celsius or with FTX and others, to give a good feeling on how MiCA may undermine such risks.
Thank you. I mean, I remember also when Celsius crash happened, and then you could hear different statements from the CEOs of exchanges. And I remember that moment when some of them actually did say, if we go under, I mean, your assets are our assets. You don't own your own assets. And that got quite a backlash. And then some of them removed those statements and those tweets from their profile because really was badly received. I mean, of course, and unfortunately, again, we did not have live regulations that can actually prevent these platforms to abuse the investors' property and their assets. So it's great that it's happening, even though many are not very excited about having uniform legislation across EU. Would you also tell us, since the regulation is very new in this space, and depending on the personal feeling and whole relationship towards the industry, what are some of the bad things, to put it that way, when it comes to MiCA? In what limitations will MiCA actually implement on EU-based businesses and the businesses that are outside the EU, but they do business within EU?
Yeah, I mean, there are some things which were discussed also, which did not really find their way in the final MiCA version, and some things which I didn't really like. For example, this proof of work limitation. I mean, it was discussed from an environmental perspective. Everyone knows that mining Bitcoin has a very high energy consumption, and it's because Bitcoins are mined by the proof of work technique, which is highly energy consuming. So it was discussed in the beginning or in the middle of the draft of the MiCA to not allow to use any coins which are mined with proof of work technology. However, or luckily, this limitation, this rule, this clause was not used anymore in the final version of the MiCA, which is now there. But we are going to have some environmental obligations towards the CASPs, where they would need to inform the users about the energy consumption of any blockchain use or any blockchain underlying blockchain of the coins. And then the ESMA is going to publish some paper, and the MiCA is going to be maybe changed in the future once we have a better understanding of how the energy consumption is really when looking at the coins. Because I think this is also something we had in the past. We did not really have real good information because there were rumors saying that, Bitcoin is using as much energy as the whole economy of Sweden or Netherlands. And some others said, no, that's nonsense. So this is also something which we are now collecting. So we're collecting information. And this is, I think, something also very good what MiCA is providing, some time where we collect information. And then based on the new information, some rules are going to come. Then there will be some information by ESMA published on reverse solicitation, which I already touched on. So it will tell exactly to the foreign companies when are they allowed to provide the services to the European Economic Area and when not. So this is going to be the reverse solicitation paper, most likely published by ESMA in respect to MiCA. And then we're going to have also some new understanding when it comes to decentralized autonomous organizations, or DAOs, because those are also not covered within MiCA. However, it also says if they are true and original DAOs, if it's something which is called, or which is calling itself a DAO, but it's not a DAO, then it may be regulated under MiCA. And it doesn't really matter if the originators of the DAO or the protocol providers are located outside of the European Union, but the members of the DAO, they're inside of the European Union. So this is something where we also would need to look at. And this is also something where I'm very interested to see what's going to happen, because this whole DAO regulation, if it's really outside of MiCA, a new regulation will come. And if it's somehow inside MiCA, because someone will say, for instance, a DAO is not a DAO if someone holds more than 10% of the token of the DAO, then you're inside MiCA. So this is something which will develop most likely in the next months.
Oh, well, I'm super excited to see how that's going to evolve, because, I mean, for example, I had a great chat with a Panamanian-based lawyer, and they basically have that since Panama is getting quite popular for incorporating an entity that represents the DAO, and they have that relation that one person cannot be holder of like more than 20 or 25% of the DAO assets, and one would hope that would never happen actually in a DAO. While in Marshall Islands, one person cannot hold more than 10%. So if they hold more than 10, they fall under certain regulations. If they don't, then they're perfectly fine. So it's really interesting to see how is it MiCA looking to recognize DAOs as DAOs, or to find some sort of like a kind of DAO-like structure?
Yeah, so what I heard, so it's just what I heard, like from the gossips, that when the MiCA, I call it MiCA 1.0, was final and has passed after the trilogue discussions on the 30th of June, there were a group of strong supporters who said we now have to continue. We should not stop with the finalization of MiCA 1.0. We should already think of MiCA 2.0. And there was strong supporters who said we should draft and do MiCA 2.0, focusing on DAOs. And there's another group of politicians who said, let's talk about DAOs, but I don't really know when MiCA 2.0 is going to come, because MiCA 1.0 is going to be published, let's say, in the next months or weeks. But then you have 18 months, which is the time until the MiCA becomes fully effective. Plus, you have 18 more months for those who are already CASPs and who would need to do a so-called MiCA upgrade. So you have 36 months from the timing when the MiCA is published. So this is a time where we will only talk about MiCA 1.0. So, and this is what I also think, until MiCA 2.0 comes, and even the text of MiCA 2.0, it will take some time. So a couple of months is very optimistic. I don't really see so. But now it comes, for those who are really like against DAOs and want to have the DAOs regulated, maybe something in between is coming. Maybe some kind of regulation, which we have with PRIPS, some specific regulations on DAO, or at least this is the minimum what I'm expecting, is a common understanding what is a DAO. And when we talk about DAO, like what is really a decentralized autonomous organization, we talk about organization and we talk about decentralized. So what is decentralized? So we've seen it with the SEC and I think FinCEN when they were talking about DAOs, and they said, okay, those who provide the protocols, who draft the protocols, they shouldn't be regulated. But those who may be running the network and those who are in charge of the token, they may be regulated. And now it comes, they said, okay, when you have a whale, and they didn't really define what a whale is, then it can't be a DAO because someone has the majority. And the majority means 50% plus one. So you have to really have the majority, you have the control. So this is 50% plus one. I think this threshold of 50% is too high. I say they either would look at the threshold which we now have in the MiCA, which is 20%. So we say anyone who's holding more than 20% is someone with a mandatory holding. And if you look at the banking sector, the banking and financial service provider sector, it is 10% or more, which is a qualified interest. So I think it's going to be something between 10 and 20%. So they either choose the 20% or the 10% threshold as a harmonized understanding when we cannot say any longer this is decentralized. So any network which has someone or group of people who work together and hold more than 10% or more than 20%, they would be seen as those who have similar rights or obligations as someone who's controlling that network. And therefore you would say that, okay, it's not a DAO anymore. It could be an entity or company.
That's very interesting, because how can you prevent someone from being a whale, right? Because if they have enough resources, enough means, I mean, unless you put a cap, but that is, I think we are kind of unfortunately still far ahead of that. And we did have cases in the past and this year when we had extreme cases of 97% of the vote was by one person, and they did really bring the issue of centralization and decentralization into question. I think it can definitely help to reduce the issue of wheels, but on the other hand, how do you prevent them? And should the whole DAO and the whole community be basically punished and seen as a non-decentralized environment because one bad apple? I think it's important to regulate the DAO so the unlimited personal liabilities are removed from the members. However, the regulation itself shouldn't really hinder the growth and the scalability of the projects, rather support it and offer different types of protection those that are involved. So, I mean, I hope they will at least wait until MiCA 3.0 to get that part well. And thank you very much for explaining all this. Actually, I would go back to that whale issue and 50 plus 1 or 20 or more than 20%. Could you comment on how will that, for example, apply to liquid governance, right? So because in liquid governance, the members can delegate their voting power to a wallet, to a specific person they trust, because they've been in the project for a very long time, or they have the necessary expertise to vote on that behalf. So how could that impact the liquid governance, and whether that could put the project in danger?
Yeah. So we have something like this already in place when we look at the traditional world. So in the traditional world, when you have a stock listed company, so an exchange listed company, we have so-called disclosure requirements where you really look at who's holding the shares, who is exercising the voting rights, is someone exercising the voting rights on behalf of someone else. So we can use the same knowledge we have already from the traditional world. And the knowledge of the traditional world says that if you have someone who's exercising the rights, is this someone doing it by its own discretion, or is it asked to do so explicitly by the beneficial owner or by the one who is originally owning that right? So if I would give my rights from the token to you and would say, please exercise it exactly in this way, then one would say, okay, we do not need to look at Aleksa, who is exercising the rights, but we need to look at the person behind and look exactly at the interest that person behind is holding. Because if we would look at you, you may have received these instructions by 10, 20, 15 different people, and then you would easily cross that threshold of 10 or 20%. However, in many cases, people say, okay, this is my right, this is my token, do whatever you think is best. So if someone is giving you this instruction, that you would have the discretion to do whatever you want to do, and then you could use that discretion because you have received it from different people, and then the law would say you, as the one who's exercising the rights and you have your own discretion, you should be treated as the one who may have control or significant influence on the DAO, and therefore you would be regulated, even though you're not the beneficial owner and the rightful owner of the token, but you're exercising the rights. And this is exactly how it works in the traditional world, where people really give away their rights. They maybe even receive some money for that. They give it away, say, I don't care, do whatever you want, as long as it's my token, and then I'm getting some interest because you're exercising the rights on your own interest, and then they would apply the law and regulation on you because you have discretion.
Oh, okay. Thank you for this. I mean, and usually those that are delegated the voting rights do receive some sort of rewards for the contribution they're giving to the community and the project, to put it way. And also some projects have validators, and they also receive rewards from the community for the fact that they're voting on their behalf and representing their voice. So this will definitely have quite of an impact on how DAOs structure their governance. And I have one more question, please. You mentioned that MiCA applies in European Economic Area. However, as we know, Switzerland is not part of either EU or EA. And so many projects are actually established in Switzerland because they were one of the first that came with some very crypto-friendly laws, and they're well known to be a tax haven, and many projects still today are incorporating entities representing the DAO there. So how will MiCA affect them?
So MiCA will affect any company located in Switzerland, as I discussed in the beginning when I was explaining the reverse solicitation. So it means if a company is inside Switzerland and is providing the services to in Switzerland-based investors or users, and may accept some Europeans, because the Europeans, they go on the webpage and they say, I want to participate, then they're allowed to do so. Then MiCA is not going to apply. But if the Swiss company is only located in Switzerland because the tax environment is very friendly and there are lots of tech experts who help to build up the blockchain and so on, but in fact, 80 or 90% of the users, they are located in Europe, then MiCA would apply 100% to that company, forcing that company to have at least a subsidiary inside the European Union and to apply for MiCA license, or to immediately stop any activities which are actively provided to the European Economic Area. So I think this would be the result.
So Switzerland is not a good gateway for MiCA. One would still have to apply. Thank you so much for this great talk. I really appreciate taking the time to come on and break down MiCA, and I learned a lot from you today, and I'm sure the listeners have as well. Anyone who would like to get in touch with Ali would be able to do so using the socials that are provided in the description. And thank you, everyone, for coming on and listening another episode of DAO Today. See you in the next episode.